found that was a little bit of a surprise, I think, to all of us, was that investors collectively purchased about 27% of all residential homes that were sold during the first quarter. We're in a really weird period right now where home prices have gone up 45% since 2020, and then mortgage rates doubled back in 2022. Our data showed just the opposite. It showed that these big institutional investors collectively own 2.2% of the inventory that's out there, of the single family rental properties.
Hey everyone, my name is Preston Zeller. I'm the Chief Growth Officer at BatchData, formerly Batch Service. I'm here with Rick Sharga. He's the co-founder, CEO of CJ Patrick, which does analysis in the real estate industry. Rick, welcome. Good to have you on.
Nice to be here, Preston.
Yeah, so we have been working with Rick and with BatchData to really understand, what has been going on in the investor single-family market, which hasn't been covered really in a great way historically. And so we wanted to take this really comprehensive approach. Rick has been really great in doing that. And so, for this episode of the podcast, I wanted to walk through some of our findings with Rick. So if you're just listening, we also have a visual version that you will be able to get on YouTube. So go check it out there as well. But yeah, Rick, so what's the headline? We did this just as a setup. We did it for Q1 of 2025. We do have another report that's going to come out in early September about Q2. But what was the headline takeaway from your standpoint of how Q1 was different from times past?
Yeah, it's a great question. And I think you're right, Preston. The investor participation in the residential real estate market has been kind of covered in a slipshod way for years without a real comprehensive view on the role that they really do play in this part of the housing market. And one of the things that we found that was a little bit of a surprise, I think, to all of us, was that investors collectively purchased about 27% of all residential homes that were sold during the first quarter. And that was the highest percentage we've seen in at least the last 5 quarters that we tracked. And it was higher than the average that we saw on an annual basis over the prior 4 years. So you go all the way back to really 2020. And this is the highest share of sales that were actually facilitated by investors across the country. So very active participation by investors when it comes to what's going on with residential home sales.
Yeah. Well, and I think one of the interesting results of this has been seeing how different news outlets are covering it. And I'm just going to pull up this one real quick that this is from Ground News, but Ground News sort of aggregates all these different places where the article is getting mentioned. And of course has like, hey, what's the bias of these media sources? Are they left, right, or center? And let me make sure I'm still sharing my screen here. I'm going to reshare this one tab. It'll let me. Yeah. So on this one on Ground News, we can see that, you have 39% sort of left leaning, 51% center leaning, and then 11% right leaning. But they all have their different kind of take on what is happening, and whether or not really this surge in activity is a correlation of traditional buyers struggling to get into an entry level home or whatever the case may be. There's, I think, a lot of mixing up going on there. Is that kind of what you've noticed there too, Rick?
Yeah, actually, we one of the reasons we were both interested in doing this analysis and we've created this now quarterly report called the Investor Pulse that will continue to come out from BatchData, is that we believe there were some misperceptions in the market about investors. Mm-hmm. There's a kind of hard to kill rumor, an urban legend that Wall Street is gobbling up Main Street. This thing is harder to kill than the rumor about alligators living in the sewers in New York City, and probably equally inaccurate. So there is a little bit of reality in the headline that you're sharing right now.
Hmm.
Affordability for people trying to buy a house, according to the Atlanta Federal Reserve, is probably the worst it's been in about 40 years. So you have to go back to the 1980s when interest rates were 15, 18, 20%. And that really killed affordability for a lot of potential home buyers. We're in a really weird period right now where home prices have gone up 45% since 2020, and then mortgage rates doubled back in 2022. And that kind of 1-2 punch really killed affordability for a lot of prospective home buyers. So we've seen a drop off in the number of traditional home buyers who are looking to buy a property. The demand is weaker because affordability is so poor.
Hmm.
What's happened though is I think investors have continued to buy slightly higher percentages of homes over the last few years, but because traditional buyers have dropped off a cliff, it looks like investors are gobbling up a disproportionate share of homes, and that's really not the case. They own about just under 20% of all residential single family homes across the country. I'm not sure that percentage has changed all that dramatically in the last 20 years, but the percentage of homes that they're buying today looks disproportionately high because traditional buyers have slowed down a lot. And we've gone from selling about 7 million homes back in 2021 to about 6 million in 2022 to about 5 million in 23 and 24. And that's combining new homes and existing homes. And we're running slightly below that this year. So if all investors do is continue to buy the same number of homes, their percentages will continue to go up as as part of that mix. The other misperception that's in the market, and I know we'll get to this momentarily, is the nature of these investors. And this
Hmm.
was a really important finding, I think, from this survey. There was a really awful report that was released from, I probably shouldn't mention the company because it was that bad of a report about a
It's
year
a,
ago
and
that
let people
said
people can go Google it.
investors, institutional investors, we're continuing to gobble up all these properties, and within the next, within by not by not, by 2030, could own 40% of all residential properties. I don't know what this was based on because the data certainly doesn't reflect it. But our data showed just the opposite. It showed that these big institutional investors collectively own 2.2% of the inventory that's out there of the single family rental properties.
Yeah.
And in fact, the mom and pop investors, the people that own 1 to 5 units, comprise 85% of the single family properties that are investor owned. So this was, I think, an important study to release in order to kind of set the record straight, because we have media, we have consumer activist groups, we have politicians who are proposing legislation that would really come down hard on investors in an effort to keep them from, quote unquote, gobbling up all the inventory, when in fact that's simply not the case.
Yeah, well, and to that note, a lot of that, a lot of them, quote, gobbling up the market, right, has happened for kind of decades leading up to this, right? Not just like
Yeah, if
it's
you
it's not
we
this exponential thing that they continue to do.
no, I mean, if you go all the way back to 2009, and I picked that date very specifically, Preston, because that was the year after the housing market crashed in '08.
Hmm.
And that was the first time institutional investors really started looking at single family properties as kind of an asset class. And that's when they entered the market. And
Mm.
candidly, if they had not entered the market when they did and started buying as many properties as they did, the housing crisis that we hit in '08 would have lasted an awful lot longer. They actually bought up a lot of the bank owned properties, a lot
Hmm.
of the vacant homes that were sitting there that had been foreclosed on. They rehabilitated the properties, brought them back to market, mostly as rentals. In some cases, they bought them and ultimately sold them. But it's a misperception. It's kind of misstating the role these big investors have to say they fundamentally changed the market overall. Historically, we've had millions of these properties across the country that have been owned by landlords and rented out. It's just that the landlords tended to be kind of mom and pop investors, small to mid-sized investors. But if you go back to 2009, there were already about 12 million of these properties across the country. Today in 2025, we're looking at about 17 million. So the number's gone up, but it's also gone up commensurate with population growing. We now have
Mm,
370 million people in the country. We have the millennial generation coming of age to form households. They can't afford to buy a house, but they have growing families that need more space. Maybe they want to be in a school district where they can't afford to buy but would love to rent. And so this inventory that the investors own is really filling a need in today's housing market for rental properties for people who ultimately would still like to become homeowners but can't afford to in today's market.
yeah, and I think a good distinction too for someone who's listening, they may not be totally savvy with the market. I mean, this is all transactions, right? Because
Yeah.
you have the retail side, which people see. There's a sign in the front of the yard. It's on Zillow, whatever. But then there's all the transactions that happen, off market, which is where a lot of these investor transactions happen, right?
Yeah, well, they buy from both,
Yeah.
and the local investors, the mom and pops, tend to have really good connections with local real estate agents. So they're either getting an opportunity to maybe bid first sometimes, or to find out about properties that the agent just aren't able to move, that
Yeah.
they might be able to buy at a little bit of a discount. And so there is that. There's also historically been a large number of these properties that are in foreclosure that are in pretty serious states of disrepair
Mm.
that a first-time home buyer really shouldn't be buying.
Right. Yeah.
I don't know about you, but historically, my best tool when it comes to home repairs used to be the Yellow Pages, and now it's Angie's List.
Yeah. Yeah.
Um, but you don't want a first-time buyer who's not really a fixer-upper kind of person to be buying these properties that have everything from holes in the wall and missing electric lines and pipes for plumbing to structural damage. But
Hmm.
an investor who knows what he or she is doing buys these properties, fixes them back up, makes them habitable for the homeowners, then brings it back onto the market. And again, in some cases it's rentals, but in a lot of cases, these local investors are buying these properties and ultimately flipping them.
Yeah. No, that's a good point. And I know there are some standout states in this, right? So we have Hawaii and Alaska, big tourism places, Vermont, Wyoming. Some of the like kind of
Yeah,
migrationary stuff.
these were some surprises actually. You don't typically think of states like West Virginia and Wyoming, and I guess Arkansas was another one of our surprise states as being investor targets. But if you look at a state like Arkansas or West Virginia, if you look at states across the Midwest, Indiana and Wisconsin and the like, you find states that have relatively strong affordability compared to a California and a Hawaii and a New York. And
Mhm.
so for an investor, you can go in, buy a property at a reasonable price and rent it at a reasonable price and still be making positive cash flow day one. So a lot of the investors are looking at these lower price states like Arkansas and West Virginia that also are much friendlier to landlords than states like California or New York, where it's if a tenant decides to stop paying you, it's just about impossible to collect and
Yeah.
almost equally impossible to evict.
Yeah.
But some of the other states that were a little surprising, you take a look at Hawaii and Alaska. I mean, Hawaii, 40% of the residential homes in Hawaii are owned by investors. 36% of the homes in Alaska are owned by investors. Very high percentages,
Hmm.
which kind of threw us for a little bit of a loop until we started digging into it. And then you realize that in a state like Hawaii or Alaska that's heavily dependent on tourism, a lot of these places are vacation rentals,
Hmm.
or they're Airbnbs or Verbos or something like that. Sometimes they're second homes
Hmm.
that are owned by these investors. So in that sense, it actually starts to be kind of logical.
Hmm.
And what we don't show on this chart, but the other thing that did come through pretty dramatically is the other trend in investor ownership tracks completely along the lines of population density. So if you look
Hmm.
at states that have the highest number of rental properties, you're looking at states like California and Florida and Texas,
Hmm.
which also makes a lot of sense. So Texas, almost 1.7 million properties that are rental properties. California, almost 1.5 million. Florida, about 1.2 million. And these states also do a fair amount of tourism, but it's a population density model. One of the other things that this validates, this particular slide validates. So I've done some research for a private lender called RCN Capital, and we've surveyed investors. One of the things that we found is about 90% of investors focus almost exclusively on their home states. So when you look
Hmm.
at a population state like California, the highest population in the country, like Texas, like Florida, it kind of makes sense that these investors are looking for properties where they live,
Hmm.
and so these numbers are high. But none of these states was over 20% of the homes in the states being owned by investors, whereas we saw those percentages higher in some less populous states. So interesting trends on both sides of that equation.
Yep. And then, if we go to the large investor activity, right, which we kind of touched on earlier, we're seeing basically a kind of retreat of sorts, right?
Yeah, and this also flies in the face of Wall Street gobbling up Main Street.
Yeah.
If that were the case, these investors, these large institutional investors who own more than 1,000 properties, and by the way, there's probably only a dozen or so of those across the country. It's a very small group of investors. But if they were really gobbling up Main Street, if they were really causing inventory shortages and making it really difficult for first-time buyers to find properties, we would see them buying more properties and selling fewer properties.
Hmm.
And in fact, that hasn't been the case for the last 5 quarters. These larger investors have been selling off more properties than they've been buying consistently, quarter over quarter, year over year, for these like now it's the last 6 quarters. But it's not an indication that they think single family rental properties are a bad idea. They've shifted their strategy, and they've shifted in a way that I think is actually good news for the overall industry.
Hmm.
So rather than competing with individual buyers or with smaller investors for existing homes, they're working with builders and building entire communities of single family properties to rent out. This is what the industry is referring to as the build to rent or BTR initiative. And these bigger investors are redeploying the capital that they used to deploy buying individual houses toward building these properties, building these communities ground up. And from an investor standpoint, an institutional investor standpoint,
Hmm.
makes a ton of sense. They have more control of the quality of the assets they're buying, more certainty about the maintenance requirements. They're all centrally located, so they're easier to manage. So if you're managing a bunch of properties, it makes a lot more sense to do something like this. But while these guys are kind of pruning their portfolios and paring down the number of properties they have, the smaller investors continue to buy more properties than they sell. And
Hmm.
that's also been true year over year and quarter over quarter. So if this trend continues, by this time next year, we'll probably be looking at institutional investors perhaps having as little as a 1% market share. So it's again, it flies in the face of all the press that you've seen, all the politicians making speeches about these dangerous institutional investors. Reality is there's millions of prospective home buyers when things get a little bit more affordable. That's who the other home buyers are going to be competing with, not some hedge fund on Wall Street.
Yeah, and I think to the comment you made earlier, someone projecting out to like 2040, it's like, well, how could you really make a good conscious projection out another 15, 16 years of consistent, chunk of the pie getting acquired? Like that's not the real estate market changes too quickly for that. And,
It does, and there's so many other economic factors that go into what happens in the real estate and the housing market
yeah.
that it's to your point, it's kind of irresponsible to make those kind of claims, particularly without any data that supports it. And when you look at the underlying data as we did, and it's pointing in exactly the opposite direction,
Mm-hmm.
it's really hard to kind of just stand by and watch this kind of nonsense being dispersed.
Yep. Well, and we've talked about this too, because one of our goals is to potentially be able to say, hey, based on what, the past year and then some years leading up to that, what could the next year look like? And even some of the, pitfalls there of saying, what could the next year look like? I mean, going back, really since rates started going up in 22, how many people were really looking at the Fed going, okay, and all the banking institutions too, here's our projection for how many rate cuts there's going to be. And like everyone's been totally wrong, because
Yep.
unless you have the Fed in your pocket, I don't know who does, then how are you going to know that? And as you said, the continually changing nature of the economy. So as interesting it is to maybe put out some theories about the next year, real estate bingo card game, it's really hard to do that.
I at the risk of sounding hopelessly cynical and jaded, some people are much more interested in getting clicks than they are in being correct. And,
Sure, yeah.
and I think that's you never lack press when you predict disaster. And I think that's
Right.
I think that's a little bit of what we're seeing here. But to your point, one of the other things that I think is really uh, something people should think about is the mortgage rate issue. We're in
Mm-hmm.
an incredibly rate sensitive market right now. When
Mm-hmm.
mortgage rates dipped down close to 6% in June, we saw a flood of people applying for loans.
Yeah.
And it wasn't even really that close to 6%. It was just a little bit below 6.5. So people are looking for any indication that there's going to be a slight uptick in affordability before jumping into market. And that, at the moment, is one of the advantages investors have. If you're an investor, probably 6 or 7 times out of 10, your next purchase is a cash purchase. And so you're less vulnerable to those swings in mortgage rates and interest rates. And even investors who finance have a tendency to fix and flip these properties. So it's kind of a bridge loan. It's a 12 to 18 month loan. So if interest rates go up a little bit, you're not paying for the next 30 years on that higher rate. So I do think that's one of the other reasons that we've seen the investor share of sales go up a little bit, is that they do very often have the option of being cash buyers, and that helps in a market like today's.
Yep. And they're going to have access to better, investor sources versus, the average person is just, they're all by themselves, right? And what they can afford
Yep.
versus, hey, there's a business behind this. It's been interesting too to see, of course, like how, we've had different people in California, Georgia, and some other states kind of reach out for, hey, what's going on in their local area? But it all seems to continually tie back to, hey, investors are picking up homes here a lot, but we still can't seem to get out of this affordability issue, which, to your point you were just making, very interest rate driven.
Yeah, this particular story was kind of interesting. The reporter who wrote about this is not a huge fan of investors. Kind of a kind of a kind of a '60s renegade who doesn't want to see the man keeping us down.
Right, right.
Um, but had to acknowledge that the percentages in California probably weren't as high as
Hmm.
what you might otherwise have been led to believe. And we did find a couple really interesting counties in California where, as the subhead here says, there was one mountain region, one small county in California where investor ownership was at 83%, but it's at a small town where almost nobody lives
Yeah.
there all year.
Sierra,
And so
Sierra County. Yeah.
strictly,
Uh-huh.
yeah. I mean, if you live there all year, you're probably a hermit living in a cave. So
Right.
it's just, I mean, a beautiful area. Don't get me wrong, but so you do see these kind of variations, and when you dig into the data, you see there is a logic to all of this, and it's probably not something that people should be getting all concerned about, and not really an indication of a worrisome trend that's going to make it impossible for people to own homes.
Right. Yeah. And here was from the LA Daily News. Oops, let me pull back up the clip here. But this kind of has the national look from our data. So they made their own chart here. But as you were kind of saying earlier, California, Texas, Florida, they're not nearly as big as some um, other county or other
Yep.
states, right?
Yeah, and
So,
you can. So again, you have some of the surprise states like Arkansas and West Virginia,
mhm.
maybe Oklahoma. Um, you look at Wyoming and Montana; they're not densely populated
Yep.
states, but they are kind of lifestyle states, and so you see some opportunities there. We had people moving out of the coastal areas into some of these less expensive markets when COVID hit, and they could now work from home. And so maybe before they bought a house, they were interested in renting one. So it's bringing inventory to market. Maine and Vermont, interesting states in the Northeast, and those are the kind of states where the investor purchase activity probably looks more daunting than it really is, because in the Northeast in particular, there is a shortage of homes available for sale. So any
Hmm.
one that goes to an investor, is probably it probably feels more painful than it does in another state. Um, Maine is uh, Maine is short about. I think they've done a study on this. They're short about 86,000 houses based on current demand. So you can see where an investor going into buying a house there is something that the local community might be a little bit less than excited about. But
Yeah.
but again, uh, what this really does show across the country is that investors really aren't eating up as much of that inventory as the press would have you believe sometimes.
Yeah, and one quick thing I want to mention here, because we're going to wrap this up and people can go download it, is just how this report is stirring up conversation on
Yep.
X, and people talking with Grok about it. So, for those who don't know, Grok is the LLM that X owns. But yeah, so people asking questions. Charlie Kirk said we need to put a stop to this, um, and this is like you know another one of those sort of maybe sensational headlines. But
Yeah, so Charlie got half of the data right and
yeah,
whiffed on the other half. When he says that they bought one, when he said investors bought one out of four homes, he was about right. But then he went on to say BlackRock, and BlackRock wasn't one of the people buying one out of four homes. They were selling. So again, I think as we get subsequent issues of Investor Pulse out, we start to get the media more aware of the reality of the investor role in the marketplace. We'll put some of these misperceptions to bed, but it's unfortunately not something we can do with one report.
100%. And this was a good example too from Wall Street Apes, where someone actually responded and asked a very valid question: what's considered an investor in this report? And
Yep.
they pulled, I think, accurately from our report to account for those small owners. And that's again, we keep kind of going back to this, but it's really important. That's a big you know asterisk on all the who's buying what, is like the just the general sphere of investing is so much bigger than institutional buyers, which are kind of like the doom and gloom headline.
We took a much broader view of investor owned properties than what's been done traditionally. One of the other companies that's been looking at investor activity over the years only looks at properties owned by um, an entity with a business name. So
Hmm.
a corp or an LLC or something like that. And we believed going in that this eliminated a huge number of people who probably were accidental investors who bought a house, had tons of equity because prices went up, had a 3% mortgage, didn't really want to get rid of that mortgage, but tapped into some of their equity to go buy another house and
Hmm.
now are renting the first one out. Back in 2022, I saw a huge upswell in the number of people that owned one extra house. And
Yeah.
that's something that also typically doesn't get included in these other investor reports. So I do believe the Investor Pulse report that we put out is probably the most comprehensive in terms of looking at all investors that the market has seen to date.
Yeah, awesome. Well, yeah, and if you haven't had a chance to if you go to batchdata.io, there's a link on our website. I'll also put it in the show notes to go get the Investor Pulse report for Q1 of this year. Q2 will come out in September. Rick, thanks for coming on. I'm looking forward to just getting more into these insights and helping people be more educated on what is going on in the investor market in the U.S. So
Always happy to do these, Preston.
cool. Thank you.